The United States will not allow their new industries to be destroyed by China's imports as it happened in the steel sector a decade ago, US Treasury Secretary Janet Yellen said today. Remarkably, she made such warnings negative for Beijing following the results of her recent meetings with the top Chinese officials. Interestingly, this is Janet Yellen's second trip to China in the last 9 months. Now it's aimed at improving strained relations between the two largest economies in the world. At the same time, the US notes that China's production of electric vehicles, batteries, solar panels, and other similar items far exceeds domestic demand. We have seen this story before, Janet Yellen told reporters. More than a decade ago, cheap Chinese steel flooded the global market and destroyed industries around the world. I made it clear that President Biden and I would no longer accept this reality, she said. The US Treasury Secretary met with her Chinese counterpart as well as with the People's Bank of China governor, the Prime Minister, and several other policymakers. You're aware that for China, the US is the main trading partner. For example, in 2022, the share of Chinese exports to this country was 16.2%. For comparison, China supplied goods to Japan, third on this list, in the amount of 4.8% of all its global sales. As we can see, China's exports have dropped significantly since 2022. Its recovery to previous volumes does not seem to be happening soon. If it ever happens. The year of 2023 was less successful for China's trade. Given the US rhetoric, 2024 does not promise to be very successful either. Meanwhile, the Bank of Japan governor believes that he has noted certain progress during the year of his service. A year after taking office, Bank of Japan Governor KAZUO UEDA said he had achieved the goal he set for himself when he took over, turning the bank's complicated monetary stimulus into a simpler structure. Speaking before Japan's parliament today, KAZUO UEDA meant the simplification of the regulator's monetary policy, which was technically very complex for various reasons. Fortunately, the economy was doing quite well in the previous fiscal year, which ended on March 31, so I was able to complete my mission, the official said. Importantly, the Bank of Japan made a historic decision in March. After decades of a large-scale monetary easing, its interest base rate was set in the range of 0 to 0.1%. In addition, the governor recently hinted at another rate hike this year. While KAZUO UEDA is thinking about his mission, the Japanese yen is getting catastrophically cheaper. Today, its rate against the US dollar continued to weaken and reached 151.9 by the beginning of the new year session. Moreover, many analysts define 152 yen as a critical level. Breakout of this particular resistance will trigger immediate forex intervention by Japan's monetary authorities. According to Prime Minister Fumio Kishida, if necessary, all available means will be applied to cope with the excessive fall of the yen. However, the main factor to cap the pair's move today was not the warnings of Japanese policymakers, but the muted growth of the US dollar. Despite rally after the strong US non-farm payrolls, the dollar index was forced to retreat and to return to the narrow trading range of 104.20 to 104.40. So, positive US economic news, although supporting the dollar index in the green zone, no longer enables its sharp strengthening. On the other hand, the US dollar today reacts to the comments of several Federal Reserve policymakers, and their stance is becoming more and more hawkish. Dallas Federal Reserve Bank President Lori Logan says it's too early to consider cutting interest rates. Michelle Bowman echoes her, saying that it's not time yet to cut rates. Neil Kashkari wonders whether interest rates should be lowered at all this year. Michelle Bowman is even more categorical and suggests that the additional rate increase may even be required. Wall Street benchmark indexes ended Friday with strong gains thanks to evidence of a healthy economy. At the same time, the S&P 500 and Nasdaq each added more than 1%, and still the S&P 500 posted its worst week since January. And today the index is trading upward within the intraday corridor between 5,157 and 5,222. Despite local bullish signals from the US stock market, market participants understand that the dollar will rise in the long term. Before the euro spikes are local in nature, the ECB statement on the key interest rate, which the markets will find out on April 11, will change the overall market sentiment a little. According to the base scenario, market expect the ECB to put current interest rates on a hold and perhaps confirm forecast for a rate cut in June. The Eurozone's inflation is declining faster than expected. Therefore, experts believe that Europe may start lowering interest rates either earlier than in the United States. At the same time, experts caution that the ECB needs to be careful. After all, a significant difference in monetary policies of the US Fed and the ECB could provoke sharp fluctuations in the currency market, especially if markets begin to perceive the US economy as exceptional. That the US economy continues to prosper without any rate cuts from the regulator. In this case, the euro obviously lacks advantage over the US dollar. However, for now, the euro-dollar pair is driven by speculative activity. The dynamic of the euro-dollar pair clearly demonstrated this last Friday, and the instrument first sank below 1.0800 and then instantly rebounded to 1.0840. This happened even though fundamental analysis pointed to increasing short positions on the euro. Interestingly, technical analysis, on the contrary, signaled the possibility of a growth of the single currency. That the euro-dollar pair was driven by opposite impulses and therefore moved sideways in the range of 1.0824 to 1.0857. In addition, do not forget that last week the instrument displayed out-market moves. The euro-dollar pair ignored both economic statistics and statements of monetary authorities, and now anything can happen. Besides, we should take into account the scenario in which speculation is the only catalyst for market moves, which goes against common sense. As you can see, the strong greenback forced oil prices to drop below $90 per barrel, but the attempt was unsuccessful. On the back of alarming geopolitical factors, crude oil has risen in price again and today is trying to consolidate above $90 per dollar. This is happening despite its impressive growth in the recent years and the overbought market. Moreover, if the current information background does not change, oil will be able to gain a foothold at new levels. As we can see today, the Brent grade were still trading for some time in the red. The fact is that Brent opened the new week with a bearish gap. In other words, its closing price at the previous session was much higher than the opening price today. In this case, the bearish impulse prevails. So, on the chart, we see a fall below $90. However, black gold continues to be sensitive to incoming political news. So, analysts do not rule out a new round of growth in oil prices. You have watched the market review by InstaForex analysts for Monday, April 8. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. So see you online tomorrow.